Alrighty, guys. Hey, Isaac Sanchez here from Virtual Lending, and I want to make this video to go over an example loan estimate. It's a question that I get a little bit too often from clients, just having trouble understanding what a loan estimate is and all the information that's provided. It can be a little bit daunting, especially if it's your first time looking at a loan estimate. If you're new to the home buying process, it's your first time buying a home, it can be a lot of information just thrown at you at once. Even if you're a seasoned home buyer, this isn't your first rodeo. A lot of times the disclosures may not be what you're used to. The industry is always changing and they're always adopting new disclosure forms. So I just wanted to take the time to go over a loan estimate that is specific to a bank statement loan program. Okay, so first and foremost, we'll get right into it, guys. Again, if this is truly a purchase transaction, you will have your property address here at the top and your sales price. Okay, so in this case, for this example, we're going to be using a sales price of $750,000, going 10% down using a bank statement loan program. Okay, so assuming if we're at a purchase price of $750,000 and we're going 10% down, our loan amount will come out to $675,000. For the purpose of this example, we're using an interest rate of 8.75. That is where you see your interest rate on the loan estimate and your loan amount. Okay, moving forward here, you will have your principal and interest payment. Again, this is only your principal and interest payment, which is also known as your loan payment, your mortgage payment, principal and interest only. Okay. Does this loan have any of these features, a prepayment penalty or a balloon payment? No and no. Okay, so one thing to be mindful of, guys, is that if you're buying a owner-occupied home that you intend to live in, there cannot be any prepayment penalties. Okay, now if you're buying an investment property, then yes, using a non-QM loan, there may be a prepayment penalty applicable. And if it is applicable, it will say right here, yes, and for how long, okay? In this case, it does not have any of those features, so we'll just go ahead and ignore that. Okay, the second section here is breaking down your monthly payment. So again, your monthly payment, guys, it's comprised of 4 different things, right? Principal and interest, taxes, which is your property taxes, and your homeowner's insurance. That's known as your PITI. Principal, interest, taxes, and insurance. That is what this section is aiming to break down here. Okay, so right off the bat, you have your principal and interest payment, which is the same as disclosed up top. Okay, so your P&I is $53.10 per month, plus your estimated escrow account. Now, what's included in your escrow account? Very simple: property taxes and your homeowner's insurance. So in this figure here, you'll see those two combined. That is known as your escrow or your impound amount. In this case, mortgage insurance, there is a section here for that, if that is applicable. On any non-QM loan program, mortgage insurance is not applicable. That will only be found on a conventional or FHA product. So that's going to be blank. Okay, so if you add your principal and interest payment, which is your loan payment, plus your estimated escrow payment, which is right here, you will have a total of $62.23 per month. That is your total PITI. Okay. Now, moving forward, this section here gives a little bit more detail into your escrow or impound account. Okay, so it's going to tell you what's included in that impound account. Okay, so in this case, it's gonna tell you what's in there. We have property taxes and homeowners insurance. They're both checked and they are both in the escrow. Okay, so before we get too much into that, do know that you have the option to include the escrow account or waive it. Now, I will say this: typically, most lenders prefer you to have your escrow account established, meaning that it's combined in your monthly payment. So every month you're making payments towards your taxes and insurance. Although it's not exactly necessary, and if you see it disclosed with your impound account, you can always change that. So all these numbers can always change throughout the process, but for the purpose of disclosures, most times they will be included upon initial disclosure, okay? Okay, so moving forward here at the bottom, you're going to have your estimated closing cost, okay? So your estimated closing cost, what is that, Isaac? Well, your estimated closing cost is a totality of all the different fees, and I say fees, I'm emphasizing that because it's very important, okay? That's your closing costs. Those are the fees that are going to be accumulated throughout escrow for all the different services that are rendered, okay? So it would be loan services, third party, we'll get into that right now, but just know those are all the fees. Now, your estimated cash to close is the actual dollar amount that you will need at closing to close this deal. Okay, so that's going to be your closing cost plus your down payment. Okay, so that's your estimated cash to close. And I will show you exactly how this is broken down. It is broken down in more detail on the second page. Okay, so let's move on here, guys. So this is the second page of the loan estimate, and this is the meat and potatoes of your LE, okay, your loan estimate. This is what you want to pay attention to. So we'll start off, before we get into it, I like to look at the loan estimate and break it up into two different sides. Split it right down the middle, okay? You have your loan costs in the left-hand column, and you have other costs on the right-hand column. Now, before we get into each fee individually, one thing to bear in mind is to understand the structure of the loan estimate. I think that it helps a lot once you understand the structure of how it's prepared, and you can see things almost a lot clearer that way, right? So the way it's broken down is almost into different sections, right? So you have your section A cost, which is your origination cost, also known as your loan cost, right? You'll have that right here, section A. Now you have section B, and you will have section C. At the bottom here, you will have section D as in delta, and that will be the total, it will be the sum of all these fees here in section A as in alpha through Charlie, okay? On the other hand, you will have your other cost column, and this will be section E, F, G, H. It will be totaled here in section I. So that's how it's broken down, and once you're able to look at it through that lens, I feel that it makes a lot more sense. But let's go into it, okay? So let's break it down. Starting off with section A as an alpha, you're going to have your origination charges, okay, and that's totaled at $11,420. You'll see the itemized line amount here and here. That's going to be each fee broken down individually. That way you can see how much each service is costing you. Okay, so right here you have your points. Now this is a very important section, guys, and I want to make sure that it's covered in detail. A lot of people ask about the points and how much does a loan cost. Well, there's two main different types of loans, right? You have your conventional and your non-QM files. In this case, we're using a bank statement loan, remember, so it's considered a non-QM file, which is a non-qualified mortgage. And then you have your conventional loans, right? So the difference between the two, aside from guidelines and qualifications when it comes to cost-wise, is that on a conventional loan, we as the broker, we're able to get paid out directly from the lender, right? There's enough spread on the loans to where they're able to pay us for bringing them clients, right? For originating a loan. Now, on the other hand, with a non-QM loan, there's just simply not enough margin for the lender and for the broker to make enough money on the loan, so we have to charge up front for our commission in the form of points. Now, the amount of points will vary just depending on the loan, so that's not a solid figure. It is a fluid figure that can change depending on the parameters of the file. In this case, for this example, it's at 1.5%, which breaks down to $10,125. And right underneath that, you're going to have your underwriting fee. Your underwriting fee is the cost that the lender is charging to actually underwrite the file, right? Underwriting is the process of making sure that the file is compliant, that it meets all the guidelines, and basically reviewing all the income documentations, everything else to make sure that you are good to go. Okay, so moving on here, we have section B as in Bravo. These are services you cannot shop for. Guys, you can't shop for your appraisal or your credit report fees. It's very simple. The reason why is to mitigate the possibility for fraud, right? If we had people ordering their own appraisals, they might have a cousin who's a licensed appraiser and, say, hey, I want you to appraise my property, my $300,000 property, and give me a value of $750 because we're cousins, So that's the whole reason why it's a service you cannot shop for. We don't get to pick the appraiser. We place the order through an AMC. It's an appraisal management company. The AMC then assigns an appraiser within the area at random. Okay, so we place the order to the appraisal. They assign an appraiser. They go out to the property. We have no contact, zero contact with the appraiser themselves. They go out completely unbiased and inspect the property. Now, the amount of the appraisal fee, again, it's going to vary on a few different factors, just based on appraiser availability, the job type. If we got to order a different sort of form, maybe a reinspection or a rent schedule form, that may also hike up the cost. If it's a multi-unit property, you might be looking at a more expensive appraisal cost there if you order it with the rush fee. Okay, so that's just a ballpark $750. Usually appraisals will cost you anywhere from $650, $550, I'd say at the lowest, up to $950, just depending on the job type, but on average about $750. Right below that, you'll have your credit report fee. Again, credit report fee, $62. That's just how it is, guys. You can't run your own credit. It has to be an authorized mortgage credit provider, $62. Section C as in Charlie, these are services that you can shop for as a consumer. Now, before we get into this, I will say that here in California, it's customary for the sellers to choose title and escrow, right? So title and escrow, usually it's, like I said, it's going to be chosen by the seller. So you, unfortunately, as the buyer, really don't have a say most of the time as to who you can use for this. But let's say, for instance, you get your offer accepted and you're looking at the closing costs and you see, hey, wait a minute, these title and escrow fees look a little bit expensive. Well, then at that point, you can have your real estate agent, negotiate for you. And they'll go back to the listing agent, the selling party, and say, hey, we noticed your title and escrow fees are a little bit expensive. We'd like to use a different provider who's more affordable. And that is completely your choice. That is completely okay as a consumer. It is your choice to shop around and find a provider that is more affordable. Okay, so you can always change that, but it has to be agreed upon in contract, okay? Moving on here. So we just covered loan costs. That was section A as in Alpha, B as in Bravo, C as in Charlie. You will see the total down here at the bottom in section D as in Delta. So that will be a sum of all the different fees in section A, B, and C. Okay, so if you total up these lines here, A, B, and C, that will come out to $15,557. Okay, so that is your total loan cost associated with this loan. Now, we covered this. Let's move on to the right-hand column, which is your other cost section. And right away, we're going to hop into section E as in Echo. And this is for your taxes and government fees. Okay, so again, this may change depending on the state that you're looking to buy in. In California, these fees aren't too much, but they will vary depending on the county that you're located in. But again, in California, it usually is customary for buyer and seller to split these fees 50-50. Ultimately, it's going to depend on what you agreed upon in writing on your purchase agreement. But again, it's usually split 50-50 between buyer and seller. So in this case, for Los Angeles County, this is about right. Okay, $450 for your county recording fee. Now, moving on to section F, you will have your prepaids. Okay, so what are your prepaids? Prepaids are items that will need to be paid up front before you can close escrow, essentially, right? The first one being your hazard insurance, which is also your homeowner's insurance. And that basically has to be paid up front in full to ensure that you have appropriate insurance on the property before you can close escrow. Makes sense, right? Lender wants to make sure that the property is insured before they give you the keys. Okay, so one thing I will say with this is that this is just an estimate, guys. This figure right here will be completely up to you as a consumer. Whoever you want to go with, is just like auto insurance, right? You shop around, get different quotes, go to Geico, go to State Farm, go to Farmers, get different quotes for your insurance. And ultimately, it's your choice. Whoever you want to use will be what's disclosed here. Bear in mind that if you see something here as a placeholder for the initial loan estimate, that is subject to change, just like anything else, any other fee here. You know, if you find one that's cheaper or a little bit more expensive, that's okay. Okay, so that's that. Moving on here, we have prepaid interest. Prepaid interest is interest calculated on a per diem basis relative to your loan amount and your interest rate, right? So if you're wondering how to calculate your prepaid interest, it's very simple, guys. Take your loan amount. We'll do it right here on the screen here. Okay, so take your loan amount, which is $675. Remember, purchase price is $750. We're going 10% down. Loan amount is $675. Multiply that times your interest rate, which in this case, 8.75%. Right? Okay. Now divide that figure by 365 days in the year. We have a per diem rate of $161.82. We're rounding up here. You'll see that disclosed right here, $161.82 per day. And how much they're going to collect is just based on when we close your file, right? So let's just say here, pull up our calendar for the purpose of this example. Let's say you're closing on September 15th, right? There's 30 days in September. So the lender is going to collect from the 15th through the 30th. That's going to be 15 days, right? So they're collecting 15 days worth of prepaid interest at a per diem rate of $161.82. $161.82 multiplied by 15 days equals $2,427. That's how they get that figure. It's just going to depend on when you close the loan. Okay, so that figure is subject to change as well. Now, moving forward here, you have section G as in golf, initial escrow payment at closing. Okay, so this section G is only applicable if you choose to impound your property taxes and homeowner's insurance. In other words, it's also known as setting up your escrow account or your impound account. If you choose to do that, if you choose to have that in your mortgage, then this will be applicable. If you're waiving your impound account, you will not see anything here. It's going to be blank. Okay, so in this case, remember, we are including it in our loan, so it's going to be disclosed here. And again, this is just for the purpose of this example. These figures are subject to change just depending on the time of the year that we're closing in, right? So in this case, let's say you're closing escrow in September. Well, the lender wants to make sure you're going to have enough money set up in your escrow account so that when your next year, next September, when your homeowner's insurance policy comes due again, right, which is $1,200, they want to make sure you have enough money in that escrow account to pay for that policy again, right? So they're going to collect 3 months up front in combination of the 12 months you're already paying, right? So you paid for a year. Now they're going to collect 3 months up front so that when next year rolls around, you have a full year's worth of payments in your escrow account to renew the policy. Okay, same thing applies here with your property taxes. The difference is that in California, your property taxes are due twice a year, right? And again, it depends on when you close escrow as to how many months of property taxes the lender is going to need to collect, right? So in this case, if we're closing in September, guys, the lender is going to collect 5 months of property taxes up front for your escrow account. That way, when property taxes come due in November, they want to make sure that you're going to have at least 6 months of property taxes in your escrow account to pay for that installment, right? Each installment is going to be 6 months worth of property taxes. So they want to make sure that you have enough money to pay for that when it comes due. That's what that is. Okay, so that is section G. Moving on, we have section H, other fees. These are miscellaneous fees. You might see other fees here on your loan estimate specifically, but in this case, you only have the processing fee. And this is quite simply just to pay, the wages of our employees that are helping us out with your file, working diligently to communicate with underwriters and yourself, gathering and clearing conditions, ultimately helping us get you to closing as fast as possible. Okay, so that is that fee. Now, same thing like section A, B, and C. If you total these up, you'll have your total loan costs here in section Delta, $15,557. If you do the same math here for other costs in the right-hand column, you total up section E, F, G, and H, you will have your total here in section I, $9,635. So now, if you take $15,557 in section D and add that to your section I total other costs, that will be your total closing costs. Okay, so let's do the math here. 557 plus, let's see here, 9635, 25,192. That is your total closing costs associated with this loan. Okay, and you'll see that right here. Now remember, guys, let's go back to page 1. We have our estimated cash to close, right? So remember, that is the total amount that you need at closing to get the keys. That is your down payment plus your closing costs, right? So you will see that broken down right here, calculating your cash to close. So we've calculated our closing costs all in this section. Now we want to calculate our total cash to close. And that will be listed right here. It's going to show you exactly the breakdown as to how they're ending up to this figure, right? So we have our closing costs, $25,192, plus our down payment of $75,000, brings us to a total cash to close of $100,192. Okay, that is your total cash to close. Closing costs plus your down payment. That's what you need to close this deal and get your keys. Okay, so this is really the meat and potatoes. Like I said, this is what you want to really pay attention to on the loan estimate. Page 2, if you're concerned about the fees, that's where you want to look. Page 1 is also a good reference for the terms of the loan. And section 3, you can go into that, but it's just more so knowledge for your information. It is useful information, very insightful, but they're hypotheticals. If you were total interest that you would pay if you were to keep this loan for 30 years, again, that's not very likely. Ideally, you would refinance once the rates come down. APR, total cost over the loan term expressed as a rate, again, if you were to keep it for 30 years. And then right here, this is kind of interesting. It tells you how much you would pay towards your P&I mortgage insurance and loan costs, and then how much of the principal you would pay off out of all this amount. So it's interesting stuff here, guys. But really, like I said, meat and potatoes here is page 1 and 2 of the loan estimate. If you guys have any questions or would like to go through the loan estimate together, I hope that this video kind of brings a lot of clarity to the loan estimate. I know it can be sometimes daunting, but I hope that this video kind of clarifies some things and shed some light. But if you have any questions, like I said, feel free to reach out to me, send me an email, and we can go over your loan estimate in detail together. Alrighty, guys, take care, and you guys have a great day.